Silver balance trap, 30%, up or down. The break. No one sees coming. Silver sits perfectly balanced, 30% above the lows, 30% below the highs. Both sides claim victory, while something beneath the surface just broke. 98 million ounces of registered physical, 325 million ounces of paper claims. March 1st, 2 weeks away. The ratio just crossed 3.3 to 1. February deliveries already exceeded 100% of open interest. China's markets go dark for 8 days, starting February 15th. The Shanghai premium, $6, and holding. India is importing 25% of the world's annual mine supply. 6 consecutive years of structural deficit. The technical chart says caution. The delivery data says, welcome to AU and Ag. If you've been watching markets long enough to remember when analysis meant more than headlines and hype, you're in the right place. This channel exists for those who verify independently. We'd be honored if you'd subscribe, not because we ask for it, but because the research here demands your attention. And before we continue, tell us in the comments, where in the world are you watching this from today? Now, let's examine what's actually happening in silver. Silver traders around the world are staring at their screens and seeing exactly what they want to see. The bulls look at the chart and see a 30% rally from the lows near $64. They call it strength, they call it momentum, they point to higher lows and talk about accumulation. The bears look at the same chart and see a 30% collapse from the peak near $93. They call it distribution, they call it a failed breakout. They point to lower highs and talk about inevitable decline. Both sides are convinced they're right. Both sides have data to support their position. And that is precisely the trap. Western spot silver sits at $82. The futures market mirrors it at $82. This is what the financial world calls equilibrium, price discovery, fair value, the market reaching consensus. But 5,000 miles away, Shanghai tells a different story. Shanghai spot silver, $88. Shanghai futures, $90. The premium is $6 to $8, and it's not closing. In normal markets, when one exchange prices an asset higher than another, traders buy the cheap one and sell the expensive one. The gap disappears in hours, sometimes minutes. It's called arbitrage. It's automatic. It's how global markets stay synchronized, but this gap isn't closing. For weeks now, Eastern physical markets have been paying $6 to $8 more per ounce than Western paper markets. The arbitrage won't work. The premium won't collapse. That tells an observer something is fundamentally different about what's being traded. Paper in New York, physical in Shanghai, and the physical is commanding a premium. While traders debate chart patterns and moving averages, something happened at the COMEX that most of them missed entirely. COMEX registered silver inventory just dropped below 100 million ounces. For the first time in modern tracking history, the number now sits at 98 million ounces. On February 10th, nearly 5 million ounces drained in a single day. JP Morgan withdrew 2.5 million ounces. Lumeris pulled 1 million. The total registered inventory fell 3.22 million ounces in one session. And here's what makes that number critical. The March silver contract currently has open interest of approximately 65,000 contracts. Each contract represents 5,000 ounces. That's 325 million ounces of paper claims, 325 million ounces in claims. 98 million ounces registered for delivery. The ratio, 3.3 to 1. More than 3 paper claims exist for every physical ounce available in the vault. Now, in theory, this shouldn't matter. Most contracts settle in cash. Most traders close positions before delivery. The system has operated this way for decades. But February just did something unusual. February silver deliveries exceeded 100% of the open interest, meaning more silver was demanded for physical delivery than the number of contracts that existed at the start of the month. Traders stood for delivery, then bought more contracts, then stood for delivery again. That doesn't happen in normal markets. That happens when someone needs physical metal, and paper settlement isn't acceptable. March 1st is now 2 weeks away. That's first notice day. The day when contract holders must declare their intention, cash settlement, or physical delivery. If March follows anything remotely close to February's pattern, COMEX faces the largest physical delivery test in its modern history. And most traders are still arguing about moving averages. The mainstream financial media calls silver range-bound. They use words like consolidation and healthy correction. They show charts with support and resistance levels. They interview analysts who talk about seasonal patterns and technical formations. None of them are mentioning the inventory. None of them are calculating the delivery ratio. None of them are asking why Shanghai is paying a $6 premium that won't arbitrage away. This is what creates the trap. The price looks stable. The charts look normal. The commentary sounds reasonable. And beneath that surface, the physical market is tightening like a coiled spring. Traders who rely on price action alone see equilibrium. Traders who study inventory data see depletion. Institutional investors who trust traditional analysis see a range-bound commodity. Physical buyers who understand supply chains see scarcity developing. The same asset, the same moment in time, two completely different realities. One will be proven correct, the other will be left scrambling to understand what they missed. The 150-day exponential moving average on the hourly chart just broke. Technical traders see that as a bearish signal. They're preparing for lower prices, they're setting stop losses, they're waiting for confirmation of support. But confirmation requires time. And time is the one thing this setup may not provide. Because while technical analysts wait for their indicators to align, the March contract is counting down, 2 weeks until first notice, 98 million ounces registered, 325 million ounces claimed. The equilibrium isn't balance, it's the moment before the break. There's a document that gets published every year. Most investors never read it, most analysts never reference it, most financial media never mentions it. It's called the Silver Institute World Silver Survey. And buried in its pages is a number that's been repeating for 6 consecutive years. Deficit. Not once, not twice, 6 years in a row. The world consumes more silver than it mines every single year. And that gap isn't closing. 2025's projected deficit, 67 million ounces. That's 67 million ounces that will be pulled from somewhere. From vaults, from stockpiles, from inventories that someone, somewhere, is assuming will always be there. But here's what makes this different from other commodity deficits. Silver doesn't just disappear into one sector, it fragments across dozens. Investment demand in 2025 surged 20% to 227 million ounces. That's a 3-year high. Investors are buying physical bars and coins at rates not seen since the panic buying of 2020 and 2021. But investment is just one piece. Industrial demand sits at approximately 650 million ounces. Solar panels, electronics, medical equipment, batteries, water purification. Every smartphone contains silver. Every electric vehicle contains silver. Every solar panel array contains silver. And unlike investment demand, industrial demand doesn't return to the market. When silver goes into a solar panel, it's gone for 25 years minimum. When it goes into electronics, the recycling cost often exceeds the metal value. It enters the economy and vanishes from the supply chain. Industrial consumption is one-way depletion. Now add this number, 220 million ounces. That's India's projected silver import for 2025. One country. 220 million ounces. That represents approximately 25% of total global annual mine production. 25% absorbed by a single nation. This isn't speculation. This is documented import data. Verifiable, trackable. India's demand is driven by both investment buying and industrial consumption. Their solar capacity expansion alone requires massive silver tonnage, and India's demand is growing. So let's do the mathematics that most market observers skip. Global mine production for 2025, projected at 820 million ounces, that's up 1% from the previous year. 1% growth, barely moving. Recycling jumped 7%, crossing 200 million ounces for the first time since 2012. That sounds encouraging. More supply returning to the market. But recycling increases usually signal something else entirely. When recycling surges, it means prices have risen enough to make recovery profitable. It means people are scrapping old electronics, melting old jewelry, turning in old coins. Recycling doesn't increase because there's abundance. It increases because there's price pressure. And even with that 7% recycling surge, even with that 1% mining increase, the deficit still sits at 67 million ounces. Now here's the part that separates casual observers from serious analysts. A single-year deficit means temporary tightness. A 2-year deficit means structural pressure is building. But 6 consecutive years, that's systematic inventory depletion. Year 1, 67 million ounces gone. Year 2, another 67 million ounces gone. Year 3, year 4, year 5, year 6. Compounding, accumulating, draining stockpiles that were built over decades. Above-ground inventories don't refill themselves. When mine supply can't keep pace with consumption, when recycling can't close the gap, the deficit gets filled from somewhere. And that somewhere is exchange vaults, national reserves, strategic stockpiles, private holdings. The COMEX registered inventory dropping below 100 million ounces isn't random chance. It's the visible manifestation of a 6-year global deficit, finally reaching the exchange warehouse. But there's another layer most people miss. The Shanghai Futures Exchange is showing something unprecedented. Backwardation. In normal commodity markets, future delivery dates cost more than immediate delivery. That's called contango. It reflects storage costs, insurance, the time value of holding inventory. But Shanghai's silver market is flipped. The front month contract, The one demanding immediate delivery is trading at a premium over contracts for future delivery. That's backwardation. And it's reached record levels. When backwardation appears in physical commodity markets, it signals one thing: immediate shortage. Buyers want metal now. They're willing to pay more for today's delivery than next month's promise. In Shanghai, short sellers are literally paying deferral fees just to avoid taking delivery. Read that again. Traders who sold silver contracts are paying penalties to delay delivery because they can't source the physical metal to fulfill their obligations. That's not normal market mechanics. That's shortage pressure manifesting in real time. The Silver Institute report shows industrial demand down 2%, primarily due to solar thrifting. Manufacturers using slightly less silver per panel to reduce costs. But here's the reality check. Even with thrifting, even with efficiency improvements, absolute tonnage requirements remain massive. Global solar capacity isn't shrinking, it's expanding exponentially. China alone is installing solar capacity at rates that would have seemed impossible 5 years ago. Thrifting reduces silver per unit, but total units are multiplying faster than the efficiency gains. The net result? Industrial demand stays elevated. And it's demand that doesn't return to the market. So what happens when you combine these factors? 6 consecutive years of 67 million ounce deficits. India importing 25% of global mine supply. Investment demand up 20% to 3-year highs. Industrial consumption locked in at 650 million ounces annually. Mine production growth stuck at 1%. Shanghai in record backwardation. COMEX registered below 100 million ounces. This isn't a temporary squeeze. This is a structural mismatch between available supply and committed demand. The Silver Institute publishes this data annually. The reports are public, the numbers are verifiable, yet somehow the silver price sits in equilibrium, range-bound, consolidating, healthy correction. The deficit has been documented for 6 straight years. The inventory has been draining for 6 straight years, and the market acts like everything is normal until suddenly it isn't. In November 2024, China did something quietly. They reduced their U.S. Treasury holdings by $6.1 billion. The new total, $682.6 billion. Most financial observers saw it as routine portfolio adjustment, normal capital reallocation, nothing unusual. But that single month was just one data point in a pattern that has been building for 14 years. China's combined holdings of U.S. Treasuries, stocks, and bonds have now declined to $1.56 trillion. That's the lowest level in 14 years. And if an analyst excludes the Belgian custodial accounts, which are widely believed to represent Chinese holdings stored through European intermediaries, the real number drops to $1.16 trillion. The lowest since 2008. This isn't a trend. This is a systematic unwinding. The largest foreign holder of U.S. debt is methodically, deliberately, year after year, reducing dollar exposure. Now, here's the question most analysts fail to ask. When $400 billion leaves dollar-denominated assets over 14 years, where does it go? It doesn't vanish into thin air. Capital doesn't disappear. It relocates. And the answer to where changes everything about the commodity markets. Infrastructure, physical commodities, strategic materials, rare earth elements, industrial metals, and precious metals. Because when a nation decides the dollar isn't the safest storage of value anymore, they don't move into euros or yen or pounds. They move into assets that can't be printed, can't be sanctioned, can't be frozen with a policy decision. Things you can touch, things you can store, things that exist regardless of which government is in power. January 2025 brought something even more significant. Chinese banks received guidance, not suggestions, guidance, to begin actively selling U.S. Treasuries, not reducing purchases, not letting positions mature, actively selling. That's not portfolio adjustment, that's strategic repositioning. And it's happening while another metric just surged past levels most economists thought were impossible. The World Uncertainty Index. It measures global economic and political uncertainty across 143 countries. It tracks policy uncertainty, political instability, economic volatility, and right now, it's higher than the 2020 pandemic peak, higher than the 2008 financial crisis. The current reading represents the most uncertain global economic environment in modern measurement history. When uncertainty reaches these levels, capital behavior changes. Investors stop chasing yield, they start chasing preservation. Institutions stop optimizing returns, they start eliminating risks. And precious metals, historically, become the asset class that benefits. There's something happening at the state level in America that almost nobody is connecting to the bigger picture. Texas just made an announcement. They're going to mint their own gold and silver coins. Not commemorative collectibles, not decorative medallions, Coins approved for IRA and 401k holdings for Texas residents. But Scottsdale Mint is involved in the production process. Now, that's a serious operation. Industrial scale capacity, and Texas isn't stopping at a symbolic gesture. The long-term plan, large-scale production for statewide retirement account holdings. Now think about what that means structurally. Texas has a population of 30 million people, millions of retirement accounts, trillions in combined retirement assets. And for the first time, those accounts will have direct access to state-minted physical precious metals. Not ETFs, not mining stocks, not paper derivatives, physical coins. In their accounts, under state backing. If Texas succeeds, Florida will follow, Wyoming will follow, Montana, South Dakota, Alaska, states with independent financial infrastructure, states with populations skeptical of federal monetary policy, states with legislative frameworks already friendly to precious metals. Suddenly, tens of millions of retirement accounts gain approved access to physical gold and silver. That's not speculative demand. That's structural, permanent, institutional buying pressure coming from a source that didn't exist 6 months ago. This is how gold went mainstream in the 1970s. Not through investors suddenly deciding gold was valuable, but through infrastructure being built that made gold accessible to retirement savings. The same mechanism is now being constructed for silver at the state level. While this infrastructure builds in America, something else is happening in the critical materials sector that most observers are treating as separate from precious metals. Morgan Stanley just released rare earth magnet demand projections. Demand could increase 477 times over the next 25 years. Not 477%, 477 times. Defense systems, electric vehicles, wind turbines, advanced electronics. Everything that defines the next generation of technology requires rare earth magnets, and China produces approximately 90% of the world's supply. Rebuilding supply independence will define the next 2 decades of industrial policy in the West, when exchanges create futures contracts for materials critical to defense and technology. It's institutional acknowledgement that strategic supply chains matter. But it also sets up the exact same dynamics that have plagued precious metals for decades. Physical shortage, paper abundance, price suppression through derivative leverage, until the divergence becomes unsustainable and breaks violently. The connection between geopolitical realignment and silver becomes clear when all the pieces are viewed together. China reducing dollar exposure while accumulating physical commodities. Global uncertainty at crisis levels driving capital toward hard assets. States creating retirement account infrastructure for precious metals. Critical material supply chains fragmenting along geopolitical lines. Industrial demand locked in for technologies that can't function without silver. These aren't separate stories. They're different expressions of the same underlying shift. The transition away from paper claims toward physical possession. The movement from financial assets toward strategic materials. The recognition that what you can hold matters more than what a screen shows you own. Ray Dalio wrote extensively about how major debt cycles resolve, not through sudden defaults, not through dramatic collapses. Through currency devaluation that makes the debt serviceable, while destroying the purchasing power of everyone holding that currency. The debt becomes manageable, the savers get crushed, and the ones who moved into hard assets before the devaluation preserve wealth through the transition. Right now, corporate bankruptcies in the United States are at the highest level since COVID. Consumer debt defaults just hit 4.8%, the highest in 8 years. The jobs worker gap turned negative, signaling unemployment increases ahead. 9 large companies filed bankruptcy in a single week. Yet commodities are breaking out. Silver up 150% over the past year. Gold up 76%. That's not economic recovery. That's currency debasement meeting supply constraints while the real economy deteriorates. And most investors are still watching the price chart, wondering when the correction will come. The correction already happened, not in silver. There's a date circled on every bullion bank trader's calendar, February 15th. That's when the Shanghai Metals Exchange closes for Chinese New Year. And it stays closed until February 23rd. 8 consecutive days. 8 days where the world's largest physical silver market goes completely dark. No trading, no price discovery, no Eastern buying pressure. And Western banks know exactly what that means. For 8 days, they can operate without the Shanghai bid absorbing downward pressure. This isn't speculation. This is documented historical pattern. Every year during Chinese New Year closure, silver experiences unusual volatility. Price drops that don't align with fundamentals. Sell pressure that appears without corresponding news. The pattern is so consistent that experienced traders now plan around it. But this year, something is different before the closure even begins. Shanghai is already in record backwardation. The front month contract is trading at the highest premium over deferred months ever recorded in modern tracking. Backwardation of this magnitude doesn't appear in well-supplied markets. It appears when someone desperately needs physical metal now and can't wait for future delivery. Chinese buyers are already paying premium prices just to secure immediate delivery. And in less than a week, those buyers disappear for 8 days. The bid that's been supporting global prices vanishes temporarily, leaving Western paper markets to set the price without Eastern physical demand as a counterbalance. History says this is when manipulation intensifies. But history didn't have a March contract like this one. March open interest currently sits at approximately 65,000 contracts. Each contract, 5,000 ounces. Total paper claims, 325 million ounces. COMEX registered physical available for delivery, 98 million ounces. First notice day, February 27th. That's 14 days away. 2 weeks until contract holders must declare their intentions, physical delivery or cash settlement. Now here's why this March contract is different from every other March contract in recent memory. February just concluded, and February deliveries exceeded 100% of the open interest. More silver was delivered than the number of contracts that existed when the month started. Traders stood for delivery, received metal, then bought new contracts and stood for delivery again. That level of physical demand is not normal behavior in futures markets. Futures markets exist for price hedging, for speculation, for leverage. Most contracts settle in cash. Most traders never intend to take delivery. But February showed something changed. Participants wanted the metal. And if February's delivery pattern repeats in March, even partially, COMEX faces a crisis because the mathematics don't work. 325 million ounces claimed, 98 million ounces available. Even if only 30% of March contracts stand for delivery, that's 97.5 million ounces demanded against 98 million registered. The vault empties. If 40% stand for delivery, the exchange defaults. Unless something changes, and there are tools available to prevent default, contracts can roll forward. March holders can be incentivized to take May delivery instead, push the pressure down the road. Cash settlement can be enforced, change the rules, pay cash equivalent instead of physical metal. Margin requirements can be increased, force leverage players to close positions. The system has mechanisms to avoid delivery failures. These mechanisms have worked for decades, but they've never been tested against this specific combination of factors. A 6-year structural deficit that's already drained global inventories. Shanghai in record backwardation before the March delivery even begins. India importing 25% of global mine supply annually with no signs of slowing. Investment demand up 20% to 3-year highs. And now, a March contract with 3.3 to 1 leverage, sitting on top of depleted registered inventory. On February 10th, COMEX registered silver dropped nearly 5 million ounces in a single day. JP Morgan withdrew 2.5 million ounces. Lemaris pulled 1 million ounces. Total registered inventory fell from 101.22 million ounces to 98 million ounces. In one session. That's not gradual depletion, that's urgent withdrawal. And it happened 2 weeks before March 1st notice day. Someone, somewhere, needed metal out of the COMEX vault immediately. The SLV Silver ETF showed something equally revealing. On January 30th, net selling in SLV equaled the entire net buying for January. One day wiped out a month of accumulation. Stop losses were triggered. Leveraged positions were liquidated. The price waterfall was brutal. But here's what the price action didn't show. The price crash stopped exactly at the beginning of month level, precisely where institutional month-end settlement needed it. And then physical silver started flowing back into SLV, even after the price collapse, even after the stop-loss carnage. Physical metal returned to the ETF. That tells a sophisticated observer something critical. The selling was paper, the buying is physical, the crash was technical, the recovery is structural. Because in a true bear market, physical doesn't return after a waterfall decline. In a shortage market, physical gets bought aggressively on price dips. Now the banks face a decision. Path 1, buy back SLV shares, redeem baskets for physical silver. That pushes spot prices higher as physical leaves the ETF inventory. Path 2, buy back COMEX futures contracts to net their positions and avoid physical deliveries. That also pushes prices higher as short covering intensifies. Both paths lead to the same outcome. Upward price pressure, the closer the calendar moves to February 27th. The higher the probability this move happens quickly, because the math is simple. If you're short silver futures, and you can't source physical to deliver, you have two choices. Buy back your position at whatever price necessary, or default, and no major institution wants to be the first to default on a commodity delivery in the modern era. The reputational damage alone would be catastrophic, so they'll pay. The question is, how much and how fast? The bearish case still exists. It must be acknowledged. Contracts can roll to May, immediate pressure can be deferred, cash settlement enforcement is possible, rules can change, Shanghai closure creates an 8-day manipulation window where prices could be pushed lower without Eastern physical buyers absorbing the selling. The 150 EMA technical breakdown suggests further downside is possible. Corporate bankruptcies are elevated but not yet catastrophic crisis levels. The system has contained these situations repeatedly over decades. Western central banks have tools, coordination, deep pockets. Maybe this time, like all the previous times, they manage the pressure successfully. Maybe March rolls quietly into May. Maybe delivery intentions stay low. Maybe the whole setup deflates without incident. But then there's the other possibility, the one where February's 100% plus delivery rate repeats, where Shanghai reopens on February 24th with even higher premiums after 8 days of no physical access, where India's import demand continues regardless of COMEX price management, where the 6-year deficit finally reaches the breaking point, where 98 million ounces of registered inventory faces delivery demands it cannot meet, 2 weeks until first notice day, 8 days of Shanghai darkness starting February 15th, 325 million ounces of paper claims, 98 million ounces of registered physical, record backwardation in the east, structural deficit in the west, state-level retirement account infrastructure being built, China systematically reducing dollar exposure for 14 years. Global uncertainty at crisis highs. The technical chart says, wait for confirmation. The delivery data says, time is running out. One will be proven correct. The break no one sees coming is the one everybody assumed the system would contain, just like it always has, until the moment it doesn't.